Hi, everyone. Welcome, and thank you for joining us on our second webinar series for first-time buyers. Today, we have Vic joining us from the UK Money Coach, and today we'll be giving you a run-through on, what credit history is, how you should understand credit scores, and really, everything you need to know about, this sort of opaque world. Vic will break it down for you. And I guess before we kick this off and hand it over to Vic, maybe a quick round of introductions. Vic, if you want to go to the quick intro slide. Yeah. So hi Nick. For those of you that haven't interacted with me yet, I'm the co-founder of Jrny. I've spoken to some of you guys on the call, and I Jrny has been really founded out of my own personal experiences and the frustrations that I share with you guys trying to buy my first home, which I haven't bought yet. And it's really a platform that's aimed at helping people like you and I get on the first step of our property ladder and breaking out of that rent trap. And maybe Vic, if you want to give a couple words before I take over.
Yeah, absolutely. So, hey, everybody, I'm Vic. I founded the UK Money Coach. I have a day job. It's in finance and banking, and I have a passion for personal finance. Through my own journey, I'm married with two kids. Through my own journey of trying to achieve financial independence and financial freedom, I've built up a wealth of experience, if you like, and been able to help a lot of friends and family along the way. Formalized it somewhat in starting the UK Money Coach, and I just enjoy helping people to achieve that freedom and get away from money stress.
Awesome. Thanks, Vic. And before we kick this off, guys, just a few housekeeping rules. We are operating a live Q&A session. So if you have any questions that you'd like to ask Vic, please do drop it in the chat. Our mediators will officiate it. If you have any questions about Jrny specifically, please wait to the end and we'll address that. And I think without further ado, Vic, over to you.
Thank you very much. I will just have a quick mention. If there's any questions to the mediators, I can't see the chat screen at the moment. So if there's anything, just stop me and we can answer them at the time. Excellent. So thanks everyone for joining. So we're going to talk about credit history, credit scores today. So I think the best place to really start is at the beginning to understand what do we mean by credit. So the definition of credit is actually that it's a contractual agreement in which a borrower receives money or something of value and they commit to repaying the lender at a later date, typically with interest. Now, the term credit was actually used in the English language around the 1500s, and that word was derived itself from Latin, credere, and it was built around trust, entrusting and believing that the lender would be repaid at a later date. And the key word there is lender and lending, because the idea of lending actually dates back even further, thousands of years, in fact, to ancient Mesopotamia. So today it's widespread. Credit agreements are widespread to the extent that many people don't even realize just how many credit agreements that they're part of. Now, common examples, which you'll hopefully recognize, are your mobile phone contract, mortgage, personal loan, even buy now, pay later, which is quite prevalent nowadays, is a form of credit agreement. So as you can see, we encounter lending and credit agreements in almost all areas of our life. So it's really valuable to take a moment to understand just how it can affect us and the choices that might become available to us. Now, if you imagine each of these credit arrangements like a piece of toast that's dropping these little breadcrumbs along the way, you can start to get the idea of what a credit history is. Now, a credit history is a record of financial information related to these credit agreements. Now, the type of information which is commonly recorded about your credit agreements include your utilization of available credit, which basically means how much of the credit that's been made available to you are you actually using. Now, as an example, how many of you are still holding on to credit cards that you don't actually use? And how much of your total available credit do they account for? The number of open and closed accounts, particularly in a short period of time, could indicate potentially risky conditions for a lender. Your length of credit history. Your credit history actually begins its life when you enter into your first credit agreement. And bearing in mind that in the UK, you have to be 18 to enter into a credit agreement, depending on your age, if you're fortunate enough to be on the younger end of the scale, your credit history may not be that long. Recent credit inquiries and applications is similar to the amount, to the number of open and closed accounts, in that a lender may be interested to see if you've been shopping around prior to applying with them for credit. And then we have types of credit. So as we saw on the previous slide, there's several types of credit arrangement. And depending on the type of credit you're now applying for, the lender may be interested in this information. And finally, public records, in particular, any declared bankruptcies or county court judgments. And then outstanding credit balances. Now, these are the balances which remain unpaid at the time of your credit report being generated. It doesn't necessarily mean that these balances are overdue. So as you can imagine, this record of information would be invaluable to anyone who might think about lending you some money. So they would look at your credit history to determine what is known as your credit worthiness. Now, this tells lenders the risk that comes with lending to you, and it helps them to assess the likelihood that you're going to repay any borrowed money on time. So having a positive credit history would boost your credit score and could open the door to better lending terms, while a negative credit history could limit your credit opportunities. Now, credit worthiness is quite an abstract term. So to make it more useful and standardized, a scoring system was developed to rank credit worthiness on a scale. And this is what we call the credit score, which we'll come on to in the next section. But before we do, I think we need to understand why credit worthiness is so important. Now, if we bring it back to basics and use an example, let's assume you've got two friends who both have asked to borrow £100 from you. Now, friend number one has borrowed money off other friends before, and as far as you know, has rarely paid them back. And even when they have, it's not been the full amount, let alone with any interest on top. Not only that, you know that this friend has asked about 5 other people before they asked you for the £100, and those other 5 people declined to lend them the £100. Then you got friend number 2. Now you're aware that this friend has borrowed small amounts from other friends in the past, but they've always paid them back in full and on time. And as far as you're aware, they've not asked anyone else for the £100 that they're now asking you for. So which friend do you think is more creditworthy? Hopefully, you're all thinking friend number 2. And this is essentially the same decision process a lender will go through when they're considering whether to lend you money or not. Now, because of the vast amount of data that is collected about your credit agreements throughout your history, all regulated lenders will check your credit history before agreeing to lend you money. So your credit history can have a material impact on whether you're going to be successful or not in getting access to essential financial services, such as credit cards, personal loans, student loans, or a car loan. Now, your credit history can also determine your ability to rent, the quality of home you can rent, and your ability to access day-to-day necessities or services like a mobile phone contract or even insurance products. So a better credit history often means that you get access to lower interest rates, which is also going to save you money in the long run. And to bring us back on topic, one of the major areas where your credit history matters is when it comes to buying a home. Because of the massive figures involved, the vast majority of home buyers will only be able to buy a home with the help of a mortgage. And the size of the mortgage and the interest rate you can get will be heavily dependent on your credit history. Now, moving on to credit scores. A credit score, as I mentioned earlier, is just a system of measuring your credit worthiness. So in other words, it's a number that shows how good you are at managing your money and paying back what you owe. Now, in the UK, there's 3 main credit referencing agencies, which include Experian, TransUnion, and Equifax. Now, these agencies collect the information that makes up your credit history, and they assign a score to help lenders to assess your credit worthiness. Now, credit scores can range from 0 all the way up to 1,000, and they're split into bandings from very poor to excellent. Now, rather helpfully, as you can see on screen, each agency has a different scoring range, but the bands are largely similar. What that means is that if you're categorized as good with one of the agencies, it's more than likely you'll be in the same band with another agency, provided they've picked up the same information. So when you're checking your credit score, there's usually a free trial period, which is then followed by a subscription service. So my suggestion would be to take advantage of the free trial period to find out what information is held about you on your credit file, and for you to identify any areas which you need to either correct or improve. Now, corrections and changes to your credit file usually take at least a full cycle, which is about a month, to show up on your file. So you won't be able to check after the correction without paying in most cases. Now, you can conduct a check on yourself, as I mentioned, and I'd actually encourage you to do that to make sure you're maintaining a good credit score with each of the individual agencies separately, or you can try a one-stop shop platform like Check My File. Now, Check My File is highly recommended, as you can see 6 years worth of data collected by Experian, TransUnion, and Equifax. But as I mentioned, you can access this for free only for the first month. So what I suggest is you download your report for free, check it over, make any corrections that you need to do, and cancel within 30 days so you're not charged. Now, moving on to the role of debt in mortgages, which I know is probably what you're all here to learn about. Going back to our example of the two friends who want to borrow £100 from you for a moment. Now, imagine this time that both friends have the exact same credit history. Let's even say that they both have a very good track record of paying back their debts on time and in full. However, this time you're aware that one of the friends already has pre-existing debts of £1,000 and the other friend has pre-existing debt of only £100. So £1,000 for one friend, £100 for another. Which one do you think it would be more risky for you to lend to as a lender? Now, of course, it's the friend that already has £1,000 of debt, because although they may be staying on top of their repayments now, when they have that much debt already, we begin to question how safe they might be from potential shocks. Maybe they lose their job or they're hit by some unexpected and high expenses. Would they struggle to stay on top of their payments? And would their repayment of your £100 be at risk? Now, this is the exact same reason why having a lot of outstanding debt, even if you're making payments on time, can make it much harder for you to borrow enough for a mortgage, as lenders are going to look at your total debt payments when they decide how much to lend to you and how much you can borrow.
Hey,
Now,
Vic,
the
sorry
DTI
to
ratio,
stop you there. We just have a quick question on that.
yeah.
They're wondering if sort of rent payments count towards your credit score, and how these are calculated and how these affect these ratios that you're talking about.
Correct. So rent payments don't automatically count towards your credit score, but I am going to come on to things you can do to improve your credit score, and rent payments is one of those ways to improve it. So I'll answer that question in a few slides' time, if that's all right.
Sounds good.
Yeah. Now, the DTI ratio is your debt to income ratio, and it's just a fancy way of comparing how much you earn versus how much you'll pay out in debt repayments. So if a large portion of your income is needed to support debt repayments, you'd have a high DTI ratio, and this can affect your mortgage affordability. So if this is you, lenders may say no to lending to you altogether, or they might offer you a smaller amount than you'd applied for, or they might charge you a higher interest rate, or a combination of these. So as you can imagine, this could have a huge impact in terms of what sort of home you're able to buy. So you would also prefer, and lenders would also prefer, for you to have a lower debt to income ratio, which means having less of an outstanding debt or other debts when you come to apply for a mortgage. Now, let's take a look at an example so you can see the full impact that having too much debt can have. Now, for this example, we'll use the #1 mortgage lender in the UK, which is Halifax, and see what they would lend to you based on you having an income of £45,000 per year. Now, this can be for one or two individuals. In scenario A, we've assumed that you have no monthly commitments and we'll give you a budget of 227,000 odd and a loan to income multiple of 4.5. In scenario B, all we've done is to add a £250 a month repayment towards a personal loan. And you can see that just because of that £250 a month repayment, your budget is automatically reduced by about £30,000. So now you can only borrow or only afford 197,000 as your budget. And it gives you a loan to income multiple of 3.9. And in scenario C, we're going to add on top a credit balance of £2,500. And suppose you have two loans, a personal and a car loan, where the total monthly repayment is £450. Now your budget is almost £70,000 lower at roughly 158k and a loan to income multiple of only 3.1. Now, I think for most of us, and myself included, our situation more closely resembles scenario C than scenario A, and probably quite a bit beyond that, which ordinarily might be fine, provided you're managing to stay comfortably ahead of your repayments. But you can see that if you're thinking about buying a home in the near future, how reducing the amount of other debts that you have could be really beneficial to maximize the budget in terms of buying that home. So if lenders base their decisions to lend to you on your credit score, the next kind of follow-on question becomes, what can we do to improve our credit score? So the first step to improving your credit score, as I mentioned earlier, is to find out what your credit score is. And as I mentioned, you can do this by checking Check My File or directly with each of the agencies. But once you know your credit score and you have a record of your credit history, you should check the information collected on you is correct. Now, this includes your address history, which is to verify that your current and any of your previously listed addresses on the report are accurate and up to date. And also, you're being registered to vote. So you should confirm that you're correctly registered on the electoral roll at your current address. Now, these 2 points are really important as they're the primary means by which the rating agencies identify you as an individual and are able to associate any credit agreements with you. Now, if they're not able to do this easily, then you may not be getting the full benefit of a good credit history reflected in your credit score. Other things to check would be your payment accounts. So you should check that all the credit accounts, loans, any other financial accounts that are listed on your report actually belong to you and are accurately reflected in terms of the balances, the payment history, and the account status. Along with that is your payment history. So you should review the payment history for each account to verify that all payments are accurately recorded and that there's no late or missed payments incorrectly listed. And if there are, you may be able to get those corrected by getting in touch with the credit provider or the lender that you hold that account with. But be aware that it could take at least a full cycle. On occasion, it can take more than a full cycle to have those updated in your file. So you're thinking about a month to 2 month window from when you review your report and find issues to when they can finally correct it. Another thing to check would be credit inquiries. If there are any inquiries into your credit report, confirm that they're legitimate and authorized by you. And what I mean by inquiries is you might have heard the term soft search and hard search. When anyone thinks about lending to you, they will search your report. That's what it means by credit inquiries. So any unauthorized or excessive inquiries can negatively impact your credit score. Now, if you think back to the friend who'd already asked lots of people for a loan before they asked you, that's credit inquiries. The final point is public records. If you've had adverse credit, check for any bankruptcies, court judgments, or other public records to ensure accuracy and relevance, especially if you've satisfied any conditions that were attached to those. But once you complete the first 2 steps, you're in a good position to start making a plan to improve your credit score. Now, to do that, you can do a number of different things, such as paying your bills on time, keeping your credit utilization low. So this is where you use less credit than you have available. For example, if you've got £10,000 of credit available to you, it's better for a lender to see that you consistently stay below 2,000 to 3,000 rather than always being at the 8,000 mark. It means that you haven't hit the cap of 10,000, but the less of that you're using consistently, the better it would appear for a potential lender. Reducing your debt. Now you can pay off your debt on time or early shows you're responsible and can manage your finances effectively. Consider credit builders. So this includes the likes of Logbox or Credito, and they work in a similar way to paying off a loan. So your monthly payments are recorded to referencing agencies, and they help to boost your score. But remember that if you miss a payment, the opposite's going to happen, and it'll actually impact your score negatively. The next one is, in answer to that question earlier, you can consider reporting your rent payments to the reporting agencies. Now, this can be done via services such as Logbox or Credit Ladder or the rental exchange scheme by Experian. But in this way, you can build up a really good credit history and credit score, even though your rent payments aren't necessarily a credit agreement. And lastly, always monitor your credit score. Seeing your credit score improve will make it easy to stay on track and achieve your goals. And this is especially important if you're looking to buy a home in the near future. Now, that brings us very briefly and very quickly to the end of the core presentation for today on credit and how it relates to buying a home, which I hope you found useful. It should also leave us a lot of time for some questions, and hopefully you guys have got some good ones for us. Now, of course, there's a lot more detail we could go into on this topic and several others which relate to your personal finances. And what we've covered here today is very generic and not tailored in any way to each of your individual circumstances. And you each will have very different and unique circumstances. And this is where money coaching could be valuable. So you might be wondering, what exactly is money coaching and how does it compare to other popular types of coaching like life coaching or career coaching? Well, you could think of money coaching as a personal trainer for your wallet, as cheesy as that sounds. So just like a fitness coach helps you to develop a plan to reach your physical health goals, a money coach helps you to create a plan to achieve your financial goals. So whether you want to save for a big purchase like a first home, you want to pay off debt or plan for retirement, a money coach can provide the guidance and support you need to make it happen, along with elements of financial education, so that you feel more confident and less stressed when it comes to thinking about your finances and your money. Now, one of the perks, obviously, of joining the webinar today, which you would have seen when you signed up, is that I'm offering everyone that attended this webinar a free 20-minute consultation with me, where we can discuss any particular concerns you have and see whether coaching might be helpful for you. Now, if you point your phone's camera at the QR code on the screen now, it'll take you straight to my booking page and you can book some time in with me. And as I mentioned, it's a completely no strings attached, free conversation. Now, as an added bonus for anyone that decides eventually that coaching might be a good fit for them, by virtue of you just signing up for this webinar, I'm offering a 20% discount to my insight session. Now, this session, the insight session, is a one-off 2-hour session where we'll dig into the detail of your finances to really understand what's going on and make a plan which will put you on the path to winning with your money and achieving any goals you might have. And obviously, considering the context of this call, if your goal is to buy that first home and you haven't spent much time bringing your finances into shape so that you can hit that goal when you find the right home, this may be something we can work on in that session. Now, this 20% discount is only going to be available to those who registered for this webinar today, so I hope you'll all give it some serious consideration. Otherwise, if you're not ready yet, but you're interested in learning more about money coaching or following me for helpful tips and guidance, make sure to follow me on Instagram. I've got my Instagram handle on the bottom there, or you can go through to my website. And you can message me anytime through either of those, my website or Instagram. If you have any questions, let me know. I'm always here to help however I can. And I think we can move swiftly on to Q&A.
Great, Vic. Thank you for a fantastic presentation. I think I can speak for the guests that I learned a couple of things today about my credit score that I didn't know. And I see Noah's asked. I think maybe we could kick it off with another sort of follow-on question from Noah here.
Sure.
Now, Noah was the one that asked about rent, and he has another question similar to that. He's asking, does his credit card balance count as a deduction if he pays it off each month, and how does that affect his score?
So your credit card balance will form part of your credit history and your credit score. If you're paying it off in full every month, that in itself will help to support a positive credit score and a credit history, because lenders are going to see that, Noah can take out loan, fine, everybody takes out loans, but he's so good at money management that he's able to pay that off every month and in full without any missed payments. Which on the other side of the coin is, if you were to miss a payment, it will impact your credit score, but I wouldn't stress out too much if you've missed one payment. If you can catch it up and then clean up your record for the remaining payments, your score will be fine. But yes, if you're paying your balance off each month, it's going to support a positive credit file and credit score.
Cool. I have another question from an A. Duran here. What's the implication of using a salary advance product, such as, the Monzo's product, where they allow you to get paid earlier than their monthly inflows?
So any sort of advance where somebody's giving you something of value and you're having to repay them back later on will be some form of credit arrangement. Now, salary advance would typically be no different, because I would assume, and I'm not too familiar with how this works with Monzo, but if you imagine if your salary coming into the month is £1,000, Monzo doesn't have that money yet, but they're giving you the £1,000. So they're lending you something of value in the expectation that that £1,000 is going to land in your account and effectively pay them back. So that's still a credit arrangement. Now, in terms of your credit score, it should be fine provided you still keep getting paid, because you're paying them back on time within the terms of that arrangement. But if for some reason they'd advanced you and your pay didn't come in, there may be negative complications for your credit file. I would check the terms and conditions of Monzo's lending arrangement to see what that implication might be for you.
That's a great point. I think that's very key for everyone to just check the T's and C's, never sign freely, and really be careful what you're signing into.
Absolutely.
I have a question from Mona in the audience right now. She's asking, would you recommend using a credit card just to specifically purchase items to improve your score?
So it's a nuanced answer. So in theory, based off of what we just talked about, if you don't have a credit card, you don't have any credit agreements, you don't have a credit score. So when it comes to someone applying for a loan and the lender, a mortgage lender, goes out to find your credit score and there's no credit score, they're not going to lend to you, because they don't know how you are going to be when repaying that loan.
Yeah.
So one side of the question is yes, it would help to have a credit card so you can actually start building a credit file, a credit history, a credit score, provided you stay on top of those payments. If you're not managing your money well enough at the moment, taking out a credit score to try and boost, a credit card to boost your credit score may not be the safest thing for you, because if you then fall behind in payments on that, it's going to have the negative effect, and your credit score is going to suffer.
Cool. So maybe, I have a follow-up question on that because that's a very interesting point. It's very nuanced, as you say. Taking out a credit card can help you, but it can also hurt you.
Yeah.
Would you recommend sort of, gamifying the system, taking a credit card out, specifically spending, I don't know, £10 on your local pub night out, capping it at that, and just paying it off on time? Would that help my score?
That should help your score in theory. Now, again, this is also nuanced because the scoring system is not an exact science. So no one
Yeah.
really knows how the agencies attribute a score to behavior. But what we do know from the basic principles is showing that you can go into debt and stay on top of the payments, not miss anything, pay in full. And as we mentioned, if you've got a credit limit of 2,000 and you stay within 500 to 1,000 every month, you're also showing that your finances are generally stable, and month to month you're not having to draw more or less. So all of these things come into the fold here. But yes, if you're generally quite good with your money and you can trust yourself to not just go out and splurge it, then yes, that would be advisable to get a credit card that you use for pre-planned purchases and you pay it off in full as part of a decent budgeting process.
Awesome. That's a great answer. And we have another question from Nick. Whoever you are, Nick, you have a fantastic name. How long does it take for you to build up your score from fair to excellent?
That is almost an impossible question to answer, because as you know from what we've covered, there's so many different factors that go into what your credit score is. I would be hesitant to give any sort of definitive answer on that. But obviously, the sooner you get started, the sooner you'll hit that score. Sorry if that wasn't the right answer.
No, that's fine. That's fine. That's absolutely okay. Hey, we have a question from Ali in the community right now. This is a Jrny specific question. Now, does using Jrny improve my credit score when I make monthly payments? That's a good question. The way it works with us is that, whenever we collect any of your rent data, your payments, we actually feed this information back to TransUnion. So TransUnion is our preferred credit provider. And that actually builds up a solid credit profile for you, which we believe should work towards bettering your score. So in a way, being on a Jrny plan and just paying monthly rent, because it is nuanced in a way, as Vic says, to in the sense that you're showing sort of consistency of payments. It should work towards you stepping up on that sort of credit ladder.
If I can jump in on that one as well, actually, just to
Please, Vic.
just to highlight the point that there's 3 independent credit referencing agencies. And as Nick's mentioned, TransUnion is the preferred agency for Jrny, which is why it's so important to check your score with all 3 of them, your history file with all 3 of them, or like a check my file consolidated view, rather than just saying, hey, I'm just going to pick Experian and my score looks good over there, so it must be good everywhere else, because they each pick up slightly different data points on you. So it's very important to check all 3, because when you come to apply for a mortgage, you don't know who that lender is going to go check your score with. So it's good to make sure you're good across the board.
Awesome. Thanks. And I have a question from Joe right now. Joe asked another question, just on top of what you're asking. What is the difference between sort of a TransUnion, Experian, and Equifax?
They're just 3 separate organizations.
It's all confusing to all of us, isn't it?
Yeah, I mean, it's if you come from the kind of the corporate finance world as well, you'll heard of credit referencing agencies for corporate bonds and things like that. It's a similar thing. They're different institutions that rate credit relationships, and they all have slightly different methodologies. And for whatever reason, lenders might prefer one or the other. And as we just heard, Jrny prefers TransUnion. So there's various different reasons why one might be better than the other. It depends on who the stakeholder is.
Maybe I could clarify. We don't prefer it per se. It's just the one that we work with right now.
Okay.
Down the line, we hope to partner with Equifax and sort of Experian as well. But it is the one that we're working with right now.
Excellent.
Another question here from actually a Jrny again, just following up on this. You talked about personal loans and car loans earlier, Vic. I think this individual here wonders what about student loans? I mean, a lot of us here still have leftover loans from university or from
Yeah.
apprenticeships. Are these taken into consideration by lenders? I think no, but it'd be great to hear your thoughts on this.
Yeah. So the simple answer is yes, absolutely yes. So
Yeah.
any credit arrangement, any loan you've taken out will be part of your credit file and your credit history. So student loans are also registered with rating agencies. Again, everyone's student loan might have slightly different T's and C's. I know mine decades ago would have different T's and C's to the loans being issued today. So it's important to check what those are. But as long as you're staying on top of those payments in accordance with those T's and C's, you shouldn't have anything to worry about. Student loans, I expect, would be managed or thought of differently to other loans in the sense that there was a distinct purpose for which that was taken out. Once you finish university or higher education, whenever you took the loan out, you're not adding to that loan. You're just continually paying that loan off. And provided you continue paying that loan off, your credit score shouldn't be negatively impacted by it. It should be positively impacted. Having said that, if you're fortunate enough to be able to pay that student loan off early, it can only do wonders for your credit score.
Okay, cool. Look, I think we have sort of before I go on to the last question from the community, is there any more in the audience, anything anyone else wants to add, ask Vic, ask me. Give it a couple of seconds. If not, I will move on to the last question from Ali. Okay, cool. So I think Ali, the last one here, asks, are there certain activities that affect my credit score more and certain activities that affect it less?
Again, I think we had a similar question to that earlier. Because it's a homologation of all of these different things that affect your credit score, it'd be very difficult for anybody aside from a rating agency to say this particular activity ranks higher than this other one or lower, vice versa. All we can all do, myself included, is try and stick within the guardrails of credit utilization, how many applications you're making, keeping on top of rent payments, etc., to stay within those guidelines, and you should be fine. Again, people also put a lot of weight on credit score, credit history, more than I think they probably should. They can get quite hung up on it. If you generally stay on top of your payments, you're not late, and you're not applying for credit every other week, you should be relatively solid.
Great. Thank you so much, Vic. Are there
Well,
any other final questions before I move on to an update really quick before we wrap the session off on our launch? Okay, no. Thank you, Vic. And guys, I think some of you on this chat have been messaging us bilaterally, and I think we thought it'd be great to just give you a live update as to where things stand at Jrny. So what we've been doing the past few months. Some of you have signed up. Some of you have gone and paid that early access fee, which prioritizes you. We spent the past few months setting up the infrastructure needed to begin our initial batch of home purchases. But as you've seen in the news right now, house prices are continuing to fall in what is the largest decline since 2008, and we're in the most challenging interest rate environment we've seen in a while, which is what's been really sort of driving this decline in house prices. People just can't afford the mortgages, can't afford houses, so that leads into that leads to a domino effect, which negatively causes house price decline. A chart here by the FT says it very aptly. In the southwest of the UK, you're seeing as much as a 6% decline. The UK in general is looking at a roughly close to 5% decline. And to that extent, we're holding off on these purchases right now because we want to avoid a scenario where as we start buying homes for you, the equity contributions that you make, we don't want these to start losing value. So we're looking to really wait for a more stabilized market before we go forward. And what we mean by stabilization is that an environment where we're seeing interest rates becoming more normalized. You're not seeing a rate hike whenever the Bank of England meets. When we're starting to see sort of an inching downwards of sort of mortgage rates and a more sort of active home buyer market. We're kind of seeing this right now, and the Jrny wide view is that we anticipate things to begin to start smoothing out, and we are very confident that we will be able to begin our first batch of home purchases in the first quarter of next year. And I'm going to preempt some of your questions. Is how are you guys going to be prioritized? How are we going to go about this? First and foremost, the ones that will always be prioritized will be those that have come through the funnel and paid the refundable early access fee. And after that, we'll be going through the first batch of home purchases in the regions where we are launching first. Now we're going to finalize that list shortly, but in a nutshell, we know you put a lot of trust in us to launch. We're working towards that, and what we can say is that launch is extremely imminent. I'm happy to take any questions on that real quick. I see someone typing. Great, great question. Q1 for us is sort of Feb to March next year. We Thanks, Chris. We roughly know, but we're just working out the final details. We will be announcing it prior to launching. I have a question in from Luis. How low do I expect prices to go? Before I answer this, let me caveat to say that we don't have a crystal ball as to how low property prices will go. I personally feel that there will be a couple more percentage points of decline as the macro environment starts to peter out. I don't think we are at the bottom yet. I do think we are probably close. We are close. I do think we are close to the bottom though. Sorry if that's a non-answer, but I just don't want to put a number to it per se. Great question, Chris. For those that paid the deposit that don't fall into the catchment areas, you'll fully get it back. It's a fully refundable deposit. This is your money at the end of the day, and we will aspire to launch in those catchment areas where there is an outflow of customer demand as well. Um, and those who have paid, you will be at the top that don't actually fall through the first batch just by virtue of not being in the same region. You will be at the top of our list to service next. No worries, Chris. And Chris, if you want sort of any other clarification, book in a call with me or our customer support team. Happy to go through anything that you may need live. And that goes to all our audience out there. If there's anything specific about Jrny that you guys want to find out more about, or if you want to quiz me as the co-founder, happy to make time for you guys to go through any questions that you guys have. I think that may be the end of our Q&A and session. Vic, I think I can speak from behalf of the audience to say thank you very much for your time. It was an extremely informative session. I learned a thing or two, and I'm sure they did too. And we'd love to have you back sometime.
Thank you. That'd be great. And just a reminder to everyone, there's that offer of the free call and a further discount. So make use of it. And I hope to speak to a few of you or more of you soon.
Perfect. Have a great evening, guys, and have a good rest of the week. The weekend is almost here. Take care.
Take care. Bye.
Bye.